Welcome to another edition of Pizz-Spectives. My name is Pizzichetta, founder of Mont Wealth, and I have the pleasure today of reintroducing Phil Strano, Head of Credit Research and Portfolio Manager at Yarra Capital. Welcome back, Phil.
Hi, Rob. It's great to be back here. It's great to have a chat with you and just talk about markets and how close we can get in 2026 to the things we're talking about in relation to how we think the year's going to pan out.
I'm looking forward to that conversation, Phil, but you weren't aware, you were the number 2 podcast that we released almost 16 months ago, and now we're up to number 57 today. So thank you for supporting the podcast and the commentary. All of our listeners are much appreciative of your time. But before I do get started, let's touch on the general advice disclaimer. Anything that Phil and I discuss today is general advice only. Anyone acting on that advice without professional written and agreed consent does so entirely at their own risk. Now, Phil, let's start on who Yarra Capital is and specifically the fixed income team.
Yarra Capital. So we are the ex-Goldman's Australian asset management business. Goldman's decided in their wisdom to leave Australia from the asset management capacity, and a management buyout occurred in 2016. And we are owned by a mix of private company and companies and management. In terms of fixed income, we are versus fixed income. So we manage just ticked over $8.5 billion now, Australian fixed income. And that is across a wide range of products in retail, institutional, everything from the high grade area of government bonds, all the way through to private credit, and effectively a lot of traded credit in between both investment grade and high yield.
Okay, and we'll break that down in a sec. But before we do get into the micro of the Yarra Capital fixed income portfolios, let's talk a little bit about macro. Obviously, you've got Tim Toohey that works in the broader team there. He's one of the great, well-respected economists in Australia. What's the house view at the moment on, let's say, Australia, GDP, global GDP, where we're sitting at the moment in the cycle? Is it cyclical? Is it structural? Let's talk a little bit about that.
We tend to believe that we are seeing some sort of a resumption of growth. The heady days of getting back to trend growth of 3% plus is probably a bit of a struggle at the moment, but the consumer is responding to the interest rate cuts that we've seen so far. And so the GDP number that came out is consistent with growth rate in somewhere in the 2% range, and that is consistent with our view going into next year. I think where we differ more is in terms of the monetary policy settings, where we think the cash rate will go compared to where the market is. We're probably sitting on the more non-consensus end right now.
And what is that non-consensus view?
So we believe that there's still up to 3 rate cuts coming over the course of the next 12 to 18 months. You know, the market pricing now is pretty much flipped. So there's effectively a one whole rate hike priced in now till the end of next year. We don't believe that'll occur. We think there's a combination of things where underlying inflation is actually lower than what that last monthly read stated or provided to the market. And that effectively, from an underlying perspective, we are still in that rating band, in the RBA's band, of between 2 to 3%. And we also think that potentially a new Fed governor, and we know that Trump's effectively already anointed Kevin Hassett, or that's the way it looks to me, will lead to more aggressive Fed rate cuts. So certainly by approaching the middle of next year, that's potentially going to put a fair bit of pressure on the RBA to start easing.
Okay. And just on the RBA for a sec, let's just touch on the economy here. What's the house view on unemployment?
Yeah, we don't see a huge amount in terms of risk and unemployment rising, albeit potentially a more moderate uptick in unemployment, but nothing overly major. No.
Okay. So it's the RBA seeing a moderation in inflation, a normalisation in unemployment. That'll just give them enough room to move. And then, as you said, the Federal Reserve will likely be more aggressive on their monetary policy. They've already stopped at QT, right? So they're starting QE as a result. So that'll drive bond yields down in the US and probably drive some bond yields down here in Australia too.
And potentially you see the Aussie dollar finally getting back over 70. I know that there's been a period of time here where people have been calling that for a while and it hasn't been occurring. But if you do get a more dovish Fed, that will potentially mean that the Aussie will finally start rising. And I think a lot of it has to do with the yield differential. Right now, yield differential is still in the US's favour. But if you get Fed rate cut in December and then followed up with early next year, that fled. And if that flips, then the Aussie will respond. You get a negative kind of growth shock from the currency rising, which will then potentially bring the RBA back into play again.
Yep. Interestingly too, there's talk in Japan about higher rates, and that's having a broader impact on yield globally. Will that have some sort of impact here as well?
I think the dynamic wait to be seen. So prospect of a rate rise in Japan in the next couple of weeks. So, what impact that has on the carry trade, time will tell. Obviously, the higher the rates are in Japan, the more the incentive for the Japanese to keep their money onshore rather than send it offshore. And so we may see some repatriation. Overall, our view is that there isn't room for further rate cuts next year. We're not going to see a return to ultra low rates that we saw certainly post GFC, which effectively peaked during the pandemic. Those days are largely over.
Yeah.
And you can see why that's the case, is that there's more demand for capital now than there has been for quite a while.
Mm-hmm.
You look at the themes right now in terms of the CapEx on AI, all the expenditure is required around an aging population, energy transition, all the money being spent on defence because of higher geopolitical risk. All of these things are placing quite significant demands on capital, which will, in any case, keep yields a bit higher than they otherwise would.
Yep, understand. Now, you mentioned AI. You've done some work. You've been around the market since the early 2000s. So you do remember the dot-com bubble bursting and the telco world wanting credit, and we're seeing similar themes at the moment. What's your view at the moment, and how does that play out?
It's, in a way, when you look at it, it's about timing. Timing's everything in markets. We can see how this all ends. It's just really hard to pick the timing. What conversation we've been whether it be investors and strategists and the like, is just talking about them and trying to understand what year they think it is in relation to the previous bubble that we saw in terms of the TMT bubble back in the late 90s. Is it 1999 or is it 98? Obviously, the tech bubble got burst in April 2000 from memory. My view is it's probably still 1998. So we've still got another 12, 18 months of pretty supported growth and valuations in markets. And it's purely because the AI companies, their CapEx is just obscene.
Yeah.
Absolutely obscene. And that's going to be supportive of valuation quite a way. But it doesn't necessarily mean that the end doesn't happen in a similar way to what happened back in 2000. And the reason why in the piece I wrote, the parallels with the European telcos, I think is so apt, because the European telcos were basically the national champions. They also had pristine balance sheets at the time, are also rated in a AA categories, but through basically overinvest and overpaying for stuff in things where returns did not measure up to expectations. They suffered a significant kind of value drawdown, and their credit ratings effectively went from basically being AA categories to triple Bs, where pretty much all of them still remain 20 years later. And a lot of the things that happened to European telcos actually happened after the TMT bust, where it really impacted in a great deal through that TMT bust that we saw in early 2000.
Yeah, okay. So putting that all together then, Phil, how do you break down your investment thesis now? How do you look at each category within credit, and how do you allocate capital?
Yeah, so it's really important that you don't necessarily go and invest based on the way things are now in the right point in time, but you have to really have a forward-looking lens in everything that you invest in and think about how the market is going to be, not now, potentially 3 years' time. And see the way the market potentially is there, adjusting your risk settings accordingly to how you think things will be in 2028, apportioning a pricing premium or discount is whatever term you want to use, to make sure that you're getting paid for the risk, not so much the risk now, but how do you see the risk evolving in the next 2 or 3 years. That's incredibly important. And that's what we do in every investment.
Yep.
It doesn't necessarily mean that you get everything right. No one ever does. But it's a key risk management tool. For us, factoring in our credit rating on everything that we look at in our portfolios based on how we think the market will evolve. And AI hyperscalers are a classic case in point. They hadn't really issued in this market yet, but I think it's only a matter of time before they try to come here, given how much debt issuance they're doing. If they were to come here now, I can guarantee you I wouldn't necessarily be apportioning their current rating settings to any kind of pricing. I'd be wanting to see a spread that's commensurate with where we think their ratings will be in 3 years' time, not so much now. Now, that'll probably mean that we won't participate in those deals, and that's okay. Someone else can take it. Your beauty of the Yarra fund is that we had a lot of flexibility. It is a multi-sector credit fund. It has an opportunity set of circa $2 trillion. Our ability to say no is our key strength.
Yep.
So if an investment doesn't stack up on a risk-adjusted return basis, we won't do it. So we basically go into the parts of the market where we're getting paid for the risk at all times through a cycle.
Yep. And where are you seeing those opportunities at the moment, Phil?
Yeah, so it's interesting. Spreads in Australia are what we call still in the fair range. The Australian market overall is still an attractive place, and that is basically the evidence you're getting of that is our spreads are wider than the US. And not only that, but our spreads on a long-term, based on long-term averages, are still around that area, around long-term averages.
What are the averages of spreads, just for the listeners to better understand?
So they vary by rating category. You are still getting deals. If you look, listeners would probably appreciate outright yield more than necessarily spreads. Outright yield is important to them in terms of what they're investing in.
Yep.
For instance, Dexter's doing a subordinated bond today. They're doing an 8-year call date on that Dexter's bond, and really strong credit quality, that a BBB plus at the subordinated debt level, which is a really strong investment grade credit rating. And outright yield on that 8-year call date is going to be somewhere in the order of 6.5%.
Okay.
So really attractive. And you can see why the book build today will probably be in excess of $2 billion for a deal that they're going to be pricing probably roughly about 600 mil.
Yeah. And so what's the spread sit over is the bank bill swap rate, which is roughly what, 3.5%?
It'll roughly be 200 basis points over the swap rate.
Okay, got it.
So 200, and that's for a corporate sub deal, a triple B utility, a senior would be less than that. It would probably be in the order of about 150.
Just because they're better businesses, that it deserves less.
Oh, no, you're getting a pickup for the subordinated debt component, and the optionality around them not calling, which is fine. You're getting paid for that optionality.
Yeah, got it. And so if I think about it, like you say, on the yield, and I then think about the spread. So the yield on your fund at the moment sits somewhere between 6 and 7%, is it?
That is correct, yeah. So at the moment, it's sitting around 6.2. We've got a pretty strong pipeline of investments that we're going into. And the running yield going into early next year should go above 6.5 quite easily. Yeah, we're seeing we're getting a lot of loan in the syndicated loan space, and that the margins there are not compressed as much as in the public space. So the syndicated loan space is an area that we've been allocating more to. We've been finding really good price deals. These are senior secured deals with effectively funded, really strong, good businesses. Good cash flow businesses funded 50% of equity, some debt on a kind of net debt to EBITDA of circa 4 to 5 times. They come in with a kind of high credit rating, but they are paying spreads of 5% plus. But as a part of a blended portfolio, it's great to have some of those assets in the mix for the boost to carry, and you get access to a diverse range of businesses that aren't correlated, not systemic at all. Yeah. So to that, the corporate sub-debt market is also really attractive right now. And that's an opportunity set that's continuing to grow.
Okay. So if you break that down then, so in my own mind, if I try and explain this to the listeners and some of my clients, then the term deposit rate at the moment is around about 4% again. So if you're generating 6.2 across the next 12 months, then it's about 2.2% spread above the term deposit rate and almost about 3% above the cash rate.
And we'll do better than that. So that running yield was only one component. So we normally get 1% or 1.5% from income gains through the course of the year from our active management.
Okay.
You're looking at more something into the 7s, and if conditions are right, certainly getting 8%.
So how do you do that via buying mispriced bonds and then the spreads compressing and then you can sell them at a better yield and then you make a capital gain?
That is certainly one component. And the other component is just the natural roll down, a steeper yield curve that you get. To give you an example, the roll down typically delivers about 15 basis points times your spread duration, which is at the moment sitting around 3.5. So you're going to get 50 basis points roughly a year in income gains purely because your portfolio overall, you're getting closer to maturity.
Okay, fantastic. So let's go into the portfolio itself. You said syndicated, corporate sub debt. What are some of the other sectors or exposures you've got within that portfolio to give you that blended 6.2%?
So once again, it's a multi-sector portfolio. So The way we tell clients about the Yarra Higher Income Fund is that we focus on and we take advantage of the broader franchise of Yarra. We're an asset manager at scale across everything in Australian credit. We had just ticked up $8.5 billion in assets under management. Effectively, all of our best risk-adjusted return ideas across the whole franchise are represented in one fund. And that's the Higher Income Fund.
Okay.
And that's what gives it its power. It's just the best blend of bonds, FRNs, hybrids.
What's an FRN?
So floating rates, no. So it's effectively a bond that hasn't got interest rate duration.
Yep.
Yeah. Structured credit and a priority allocation of private credit. We do it up to 20%. You have the hard 20% cap on private credit.
Yep.
Yeah, we think private credit does work. We think an appropriate allocation of private credit is very attractive for a fund like this, provided you don't overdo it.
Yep.
Because we adhering to the ASIC rule around liquidity, we use basically being able to liquefy 80% of assets within 10 business days. We keep that private credit component below 20%, we easily adhere to that. That's something that we stick to, and we use the private credit to provide that additional boost in risk-adjusted return. We tend to basically specialise in our warehousing space, and they are still working from a risk-adjusted return perspective where you're doing facilities with non-ADIs and small ADIs, getting average credit ratings of BBB+ or A- and still getting a margin in the 400s. Yeah, that is quite attractive total return for the risk that you're taking.
Okay, so we've spoken about the outlook, we've spoken about the risk-adjusted, the multi-asset strategy around the portfolio creation. What are some of the concerns, Phil? I know you spoke about balance sheets and earnings are in good order. What are some of the risks to investors?
Some of the risks that we're seeing in the marketplace is so some of the old tricks that we saw pre-GFC are starting to come back.
Right.
I'm sure you've probably started to see some of this stuff as well. Leverage is coming back in some products. It's important to note that we don't have any leverage in the Higher Income Fund. So we have no physical leverage, and nor do we have any synthetic leverage. And it strikes me as quite odd because a lot of fixed income investors, quite rightly, I'll call it allergic to negative returns. They don't want to see any negative returns fixed income. I completely understand that. We try to make sure that there are no negative months, let alone in the 12-month period. But when you apply leverage to investment grade, you're really leaving yourself open to significant negative drawdown.
Yep.
And we're starting to see more leverage, more levered products come to the market. And I think it's something that any of us really want to see, to be honest. So that's something that we are acutely aware of. But so to date, they haven't really debased our market yet. Spreads are still, like I said, around about that fair value level. But it is something that we're cognizant of.
Yeah, okay. So funnily enough, normally when I ask that question, I always think it's going to be a macro or a rate sensitive or unemployment, but clearly there's some dynamics going on in broader markets around leverage. And we saw it the other night too, because we're obviously having this conversation here on the 4th of December. But on Monday, as we spoke earlier about Japanese yields rising and the effect that had globally, and that was all leverage because there's money and carry impacting global markets. And it doesn't take a lot to move the dial when it comes to financial markets. So interesting that you bring up leverage. And
I think 2026 is, from an economic growth perspective, when you're looking at portfolio like the Yarra Higher Income Fund, it's effectively going to be a Goldilocks kind of sweet spot type of environment for credit still, where you're going to have growth that is hanging around that 2% mark. It's not brilliant, but from a credit perspective, an investment grade portfolio, there's certainly enough money for the assets to keep washing their faces, for coupons to be paid, and for credit quality to be maintained. And that's really important. Albeit, I think 2026 is at the period where you probably are going to see a few more bouts of volatility than what we saw in necessarily 2025.
Yep. And then just talking about that, how does the fund perform in periods of volatility? I know you can't be compared with equity, but in periods of volatility, how does the fund stack up?
Yeah, so if you go back to April, performed wrong. We envisaged that risk-off period in April. So in an environment where we should have delivered a negative return in April because spreads pushed out meaningfully, we actually delivered a positive 65 basis point return in April.
Yeah. And April, for the listeners, is when Liberation Day occurred, when Trump announced his heavy tariffs across the globe.
That's correct. And equity market was down roughly about 20% in a really short period of time. Sometimes it is about market timing as well.
Yeah.
We were of the view that we were having a risk off towards the end of this year. and we were set up for that. And so that's meant that kind of the performance has been a bit sluggish because of that. But we don't resile away from the fact that we have a view that try to protect drawdowns for our investors and then leverage into those kind of drawdown periods to make the most of it, to underpin our performance in the following 6, 12, 18 months.
Yeah. Investors can foresee at least 6 to 6.5% income distribution over the next 12 months, even with this volatility in other asset markets.
Absolutely. Yes. So, 6% distribution is something that we factor in over the next 12 months.
Yep. And for the listeners too, just FYI, when it comes to our strategic asset allocation and benchmark, we've actually got an overweight allocation to Australian corporate credit because we see the benefits of having money sitting there as opposed to having money in term deposits and cash. That's general advice only. If anyone wants to have a chat a bit to me about that, please make contact. Now, Phil, I might just wrap it up there. Thank you so much for your time. Thank you for supporting the Pizz-Spectives podcast, and have a great Christmas and all the best for 2026.
Thank you, Robert. Wish you and your family a Merry Christmas, and always great to talk to you. I look forward to having more of these chats next year.
Thanks, Phil.
Thanks, Rob.